For instance, when your business continuity plan is tested and it fails, you know exactly that in a real case it will also fail. That's an early warning indicator. Then you have identification of problems in progress. That is a current indicator. So the number of settlement mistakes, the number of fraud attempts, the number of discrepancies in the cash box, the number of people who are sick at any one time. These are all current indicators that show you the state of your business today. And then you have lagging indicators when it's too late. Something has happened already. Now, what could have happened? You could have had a so-called near miss. A near miss I define here as an event that ultimately did not cost you any money, but it could have. You had some cleanup to do, you had some work to get it solved, maybe you had some luck, just to make sure there was no loss. I call this a near miss. Could have happened, but nothing happened. The second one is the white circle here. That's expected losses. The cost of doing business, as the people in the business line would say. We know exactly, out of so much revenues, we are likely to lose so much in mistakes, in other things, in fraud over the year. So that's expected losses. You live with it, you budget for it, you try to prevent it, but you know exactly you have to consider this in your budget. And then, of course, the big no-no, that's the bullseye, that's unexpected losses. Losses you did not expect, you did not foresee, you did not plan for. Losses that cost you more than you expected, that put you in serious trouble. And these losses, the unexpected losses, is what you have to put up capital for under the Basel II regime. Only unexpected losses you need to put up capital. Expected losses go to your budget. Unexpected losses go for capital reserve. If this is too difficult to remember, look at the weather. Hello? Now it works, okay. Too difficult to remember. Look at the weather. You have the early warning flag, the leading indicator. That's the clouds on the horizon. Nothing major, it's just some clouds there. Some rain may come. Then you have the current indicator, which is the strong winds. So you already have a little storm here. Not too bad, but it's windy. And then, of course, when the typhoon is here, you know it's too late. That's a lagging indicator. Okay, how do we evaluate our indicators? First of all, we must know that the indicators we're looking at are effective, that they help us manage our business. For this reason, we must make sure that the KRI is measurable, so we can put a number to it. There is no indicator saying yes or no. That's not a good indicator. You want to be able to put a number or a ratio or a percentage to it. It must be an objective number, not something that somebody has sort of guessed. It must be an objective number. And it must track at least one aspect of frequency, severity, cumulative loss, or near miss rates. So it must be useful information. Another thing important is it must be comparable to a certain extent. So can we compare it across the business? Can we compare it back in time? Can we compare it between different departments of the bank? So all these are criteria which you may look at. Ease of use, the last one, a very important one. You must make sure that these data are available, relatively easily available. You don't want to hire extra people just to get these data. And they must be reasonably complete and accurate. They will never be 100% complete, but reasonably complete at least. So, there's a lot of things people look at, all very great for business managers who need to monitor these in particular indicators. But if you come to operational risk management, you say, are these more numbers, better controls? For the business line, maybe. For centralized operational risk manager, well, just how much more boring can you get? Right? This is not what you're looking for. You're looking for something that makes sense for you. Okay? What makes sense? You don't want users' information. The information everybody uses only that piece of information that he needs. I'm aware of that. Typical danger is data without context. If you don't know what these data are for, forget it, don't collect them. So either you have additional data to underline and explain the first data, or you just don't use these data. Then data that are not relevant for me, why do I get them? In Credit Suisse, when I did my board reports, people always said, you must report this and this indicator. And I couldn't understand why. I said, this is business line talk, this is not supervisor talk. And when once a board member called me and said, where is this indicator? You didn't provide it this month. I said, I'll send it to you by email. Before I do, please tell me what this indicator means for you as a board member of the bank. And he said, well, it is interesting. I said, yeah, sure, it's interesting, but you're a board member. You're responsible for supervising this bank. So what does this indicator mean to you in your function as a board member? Thought about it and said, actually, you're right, nothing. Don't send it to me. Okay, that's information that was not relevant for the board. But they got it because somebody insisted they must know. The more useless information you send to people who don't need to get it, the less likely they're going to read your reports. Well, I also had this case with the Swiss regulator, actually. They asked for lots and lots of data, and I wondered why. So once they called me and wanted to have another set of data, and I said, why do you want them? He said, yeah, because we want to compare with UBS. I said, yeah, but what does it mean? I fail to see what does this set of data mean. Oh, well, we just want to compare with UBS. I said, well, I'm sorry, I don't have these data, so you cannot get them. If you have a good reason, and then I start collecting them because I can see the need for you to have it. But if you don't know why you're comparing them, I'm sorry, I don't have them. Okay. So that's, again, somebody trying to be busy collecting something and doesn't know why. That doesn't make sense. So if you ask for data, know why you ask for them. If you send somebody data, think, does this person really need these data, or is it just a nice to have? Or not even interesting for them. Also very bad is late data, incomplete, inaccurate. Unfiltered data flood. The consequence is you're getting lost in details. Nobody knows anymore what's going on. Choosing a quality indicator, it has to be timely, it has to be meaningful, useful, and relevant. Only these 4 criteria. So The indicator must be in a position to identify and measure the exposure so that we can manage it. Indicator should be predictive, yes and no. Mark Leipold, he used to be my counterpart at ABN AMRO, the global head of operational risk at ABN AMRO. He used to say, or he said recently in 2009, that there have been suggestions that KRIs should predict losses. This is fundamentally wrong. KRI should be an indicator of risk, not loss. The difference is important. Only risks that you don't manage can become losses. So KRIs are addressing risk, not loss. Anybody old enough to remember this? 1986? The Challenger. 11:38 Eastern Standard Time, United States. 1 minute and 20 seconds later, that was the picture. The space shuttle blew up in pieces all over Florida. Okay, what happened? Does anybody remember the reason for this? You're too young. Sorry, I'm too old. All right. What happened was the design of an O-ring. A simple little piece that cost you probably, of a high quality, cost you probably $1.20, something like that. Blew up a multi-million-dollar shuttle. There was a design flaw which people were actually aware of, but people didn't take the appropriate action. And there was one more case, the weather. I mean, look at this. These are icicles. This is ice. This is Florida. But it was in winter. So temperatures were below zero, and on the next morning they were launching, and the combination of the faulty O-ring and the weather created the catastrophe. There were more causes. NASA, of course, did a detailed investigation, and they found that the organizational culture, remember the word culture, okay? Organizational culture for the decision-making process was a key contributor to the accident. NASA managers had known for many years that there was a problem with the O-ring, but they had failed to address it properly. Everything always went all right. Why should we change it, right? And they also ignored warnings from engineers that you should not launch a rocket on such a cold day. But again, you know, this was not properly addressed along the reporting line. So communication, culture. Typically aircraft don't fall out of the sky because one engine fails. There's a famous words of the pilot of a British Airways flight who had 4 engines malfunctioning in mid-flight. He was flying over Indonesia when he got into volcanic ashes, and all 4 engines stopped. Okay, not a nice feeling, but he managed to say this good British understatement that don't worry, we'll do all the best we can. And he managed to land the plane safely. Okay? So, several things need to go wrong before you have a disaster. Even if several things go wrong, it does not necessarily lead to disaster. So, the same thing with financial institutions. One control fails is not a major loss yet. But several controls fail, it can have disastrous consequences. So a single indicator may not raise sufficiently serious alarm because one thing goes wrong. And typically also, more than one indicator together could have provided the warning, but you fail to see the link between them. Now we come to advanced indicators, composite indicators. And I can tell you, I'm still a preacher here because not many banks are at the stage where they're using composite indicators. Everybody says it's interesting, but do we do it? No. Why not? Don't know. Okay. So, business line managers need those simple indicators, the number of, the percentage of, whatever. They need to manage these. We come to the board, senior managers, they need to have a broader picture, what belongs together. So these composite indicators are made up of several indicators that can impact each other. And they can provide that broader picture. We had a study in an organization called Fedor, which no longer exists. I created that organization as a medium of exchange between operational risk managers at the early stages. And we found that indicators typically ignored in isolation could have a meaning in combination with others. So who would have thought of that O-ring becoming a major disaster? It's just an O-ring, so what, $1.20? It's not just $1.20. In combination with cold weather, it became a problem. So we need to identify relationships between the various metrics and try to make some sense, put them together. And when you have that, do the proper analysis and come up with a combination of indicators. I know we're running late on time, so I will not be too specific here, but you have it all in your handouts. So the challenge is you have, for instance, staff turnover and training. Staff turnover, you have, for instance, ranges, that is from here from 0 to 25, here from 0 to 16, that are not the same, obviously. Then you have measures. One is a percentage, the other one is the average days in the last 12 months. It's not the same. And you have thresholds. Also here, goes from a red threshold to amber, green, and back to red. And here it's only red goes to green. Now, how do you put all this under one hat, making it one common denominator? But there are ways, and one of the ways I have here as a result, you can have a staff quality index, and the common denominator, we just called it a t-value. The methodology, anybody who's interested, we can look at this together later. The t-value comes up with the individual graphs there, and this is the combined graph. So you can see you have an index that shows you where the problem is. You can see the index is in excess everywhere where the individuals are in excess. But now you see either one of them can be in excess and creates the excess. Same here. Okay. So KRI is an interesting, fantastic topic. I could talk about it for hours. If you want to know more, contact me. You can always look at KRIs in a different context. Loss data, something else we talked about. If we go to a doctor, the first thing he wants to know is your family history, your medical history. Why does he want to do that? He wants to know whether you're allergic to something, whether you have any conditions that you should be careful about. You go and buy health insurance, same thing. They want to know everything that's relevant for them to assess their risk of payout. Right? They're not going to sell you an insurance when you're already in a late stage of cancer. And they say, sorry, we cannot cover that anymore. The airline industry, they have a very rigid regime. Any accident or near miss has to be reported to the relevant authorities so that they can investigate what the problem was. And from this they are learning and improving air safety. Okay, if you look at these pictures, that's rather frightening. Okay. These pictures were taken by a gentleman called Barry Bland, who was outside the stadium in London waiting for entrance to his soccer game, and he saw the planes overhead and took his camera and snap, snap, snap. Frightening. You don't want to be in that plane. Sorry. But things do happen. Thank you. At the financial industry, why don't we do anything about it? Why all the secrecy about lost data? It's embarrassing, I know, but it can help you to learn from other people's mistakes. So, systematic lost data is a relatively recent occurrence. It started with Basel II talking about it, thinking it was a good idea. They tested it in quantitative impact studies that you had to report the data to your regulator, and with centralized insurance management. If you have a central insurance manager, he needs to know all the data, otherwise he cannot buy insurance for the group. There were some databases which existed before, but the big ones came later. So why do we bother collecting internal loss data? Why do we bother looking at public loss data? And why do we bother benchmarking data? Doctors want to know your medical history to give you the best treatment. Insurance companies want to know what risks they are underwriting. The aviation industry wants to improve their safety record. Banks can do the same. They just need to want to do it.
Just thought you might want to know, sales aren't up, they're down.
All right, so much for data. Data must be accurate, and data must be interpreted properly. There's no point trying to twist your data. You're not doing yourselves a favor. Okay? Be honest when you have these data. Look at this. I know this is not Vietnam, this is North America. The magnitude of operational losses. And these are only losses, $10 million a piece, and only North America. Okay? And only operational losses, not credit losses. See how they've been rising? Well, these are data up to 2006. You have those with outliers, and you have the regular ones. They're rising at roughly the same level. Frightening. So if this is the trend, you don't want to work in a bank and you don't want to hold shares of a bank. Okay? So the risk manager's job is to get those losses back down. And that's the value risk management can create. Okay, now you say this is up to 2006. Okay, all right. You can say this is up to 2006. So what do we do? What about the crisis? Well, in the crisis, this looked even worse. If you look at it, 2007 was a little bit more steeper rise, and 2008 was up in the skies. Don't say it was double of 2007, because you notice the break here. It's not 70, 80, 90. It's suddenly 250 here. So we're talking a pillar that should be 4 times as high, somewhere up there. And that's really frightening when the crisis hits you. It's not just a regular rise, it's even worse. And don't say this was all investment banks, this was all American banks. The global quantitative impact study of 2009, which the Basel Committee did, shows 55% of all losses originated in retail banking. So that's more than half came out of retail banking. So it's not just investment bankings. Okay, as you can see, we are short on time. Let's leave this a little bit. Internal loss data, why do you collect them? Important is that you can use such data also for internal training. The more you can rely on an example that happened with yourselves, the more people identify with it and are willing to accept it as something that could happen again. You know, if you have never seen a fraud, you will never see a fraud, you will never recognize a fraud under your nose. Only what you have seen and learned about, you will recognize. Also for finance, it is important that the losses are booked in a proper way. This will help the performance measurement, the bonuses, risk and reward, and strategy reviews. So internal losses help you predict the body of the curve of the loss distribution, whereas external losses would be the unexpected losses, would hopefully not be in your own experience. So you depend on external losses to shape the rest of the loss distribution. Public loss data are notoriously incomplete, of course. They are dependent on what the people who publish these databases find in the newspapers and how they interpret it. Okay, let's rush through this one. Gaining insight with public loss data, well, wherever you don't have loss data of your own, where you have insufficient data, that's where you can at least have some informed decisions made when you have external data. You can use such data for scenarios. So your scenarios are not just some ideas. You have some external data that support your scenario. Capturing events, yes, a lot of people say we are recording the past, just like Basel II requires us, but then they forget that actually the data is ahead. So they should learn from the past and look ahead with that knowledge in mind. Quality data are a learning curve. If you get your first data from the people you ask them to send reports, you know exactly that the first reports are useless because they're incomplete and inaccurate. Only over time the quality becomes better. I would say give it 1 year until you have good loss data reports. The basics is you need to have a consistent taxonomy, that everybody talks the same language, and completeness, that the data are fairly complete and accurate. Let's go through this. You can read this in your handouts. This is not something I want to talk about much. Okay. Data consortia, where people share data, share loss data anonymously. So you supply your loss data to a central pool where it's anonymized, and then every member of the consortium can see that event, but they don't know it's yours. Like this, you can benchmark yourself against the industry, and you can learn from the industry. Usually in financial services, it's losses suffered on operational or credit defaults. Credit bureaus are one sort of loss data share. So there are certain benefits, which I briefly explained already. in the Asian region, we find that Korea has had its first and longest consortium. The 7 major Korean banks started KOREC, which is a loss data consortium just for themselves. They learn from each other and they model their models after the losses they have from there. The Bank of Thailand started a loss data consortium, but according to bankers in Bangkok, they say, well, it only serves the benefits of Bank of Thailand. We get no benefit from it. Now, this is not ideal because the bankers also want to learn. They want to benchmark themselves, they want to learn. So that consortium I do not consider a real consortium. Indonesia, 1st of July 2012, so just over a month to go, they want to go live with 160 banks to start sharing loss data. So a big, big project, and they're rushing to meet the deadline. Supported by Bank Indonesia, who made it more or less mandatory. Vietnam, what happened? Don't laugh, it's okay. There's a lot of other countries which haven't had the courage to start such a consortium, even though it's beneficial for them. So, if there is an interest in Vietnam, let me know. I'll get you to the right people who can help you do this efficiently and cheaply. Okay? Yes, that's also important. It has to be cheap. Don't want to waste too much money on that. Okay, I think I'm not going to talk about scenarios anymore. We are short of time. I talk too much. Just maybe 2 things. There are 2 types of scenarios which I want you to be aware of. The first one is it's a management scenario. The scenarios that you need in order to deal with a situation. And the other one is a measurement scenario, the one that you use for capital adequacy. Let's maybe do a wrap-up quickly. The risk tools that you have at your disposal is, you have the loss distribution curve there. You can see risk capital is only required for unexpected losses. Up to expected, we don't need it. For unexpected, we need risk capital. To manage, you have risk profiling, RCSA, and indicators as tools. You can use scenario analysis for the forward-looking unexpected loss part, and loss data that help you support all of these. To mitigate, you have business continuity management and you have control strategies. And you can have insurance. But insurance does not mitigate the risk, it only mitigates the effects of a loss. Last but not least, to measure, capital allocation is for capital and budget is for the expected losses. Performance measurement goes all the way. And of course, the input of management and mitigating flows into measurement. This is an overview of what belongs where. Okay, training, never forget training. The most important, your people need to know what they're doing. They need to be on the latest developments. They need to know what's going on. They need to understand. And training starts not with the juniors, it starts at the very top. Senior management must continue to learn because banking does not stand still, neither does any other industry. So you must keep learning the new developments. That goes for all the staff. Well, it's great, right? But don't want to know about it, right? I hear you, so what? Well, it all comes back to risk culture. Get that training as a part of your corporate governance. It must be a part of your corporate governance. And it only comes when the boss spreads the message. I am the boss and I want you all to listen. When I was in Credit Suisse Group, I had a mandate. Manage operational risk for this bank. The board says do it. Good luck. And I go to business line managers, they say, who are you? What do you want? Well, one day I was fed up, and I went to my CEO and said, this is an email, I want you to send it to all 45 or 49,000 staff that we have. Send it out that we have an operational risk manager, and this is something the board has mandated. Why? Because nobody knows about it. Okay, he did send out the email. The next moment, I went back to my office and called somebody for an appointment. Oh yes, of course. Okay, how about 4:30 tomorrow? Completely different attitude, because the boss said, we want this. Okay? So make sure that it's communicated from the top. So what you see is what you get. Quite frankly, it's not always what you get. There is more below the waterline. And that's exactly where risk management comes in. As a conclusion, many people don't want to believe the importance operational risk management has. 20%, 62, says the empirical study. Well, maybe the next study comes up with 45, but it's still not 20. I know a lot of people in the industry believe it's between 10 and 20. It's not. It's much higher. I said that in the beginning. The vast majority are knocked out by operational failures. Only possible when top management supports it, when top management stands behind it, communicates it. And it must have a firm place in corporate governance. Proper operational risk policies must be implemented. Basel II mandates it. Even without Basel II, it is just common sense that you do that. And contrary to what many people in the business line want to tell you, operational risk managers are not here to paint the devil on the wall. It's all about learning to see the dangers below that waterline. And with that, I conclude my slides. I'm sorry I couldn't go through all of them. I meant to well. I meant to give you more, but time is a constraint. I'm anytime available to answer your questions. Send me an email later if you have a question to one of my slides, which I could not go through today. No problem at all. I'll answer you.
Thank you so much, Mr. Hansuri, and I'm sure that you have so much more to share with us, and that today is just the beginning of what we see above the surface. Okay? And now I'd like to get to the Q&A sessions. Okay, sorry. So now we'd like to get to the Q&A session. So if you have any questions at all, you can give it to one of our volunteers who are in the room, or you can ask them yourselves. We have Mr. Lee and we have Mr. Hansuri here who are available to your questions. So please ask away. And before we start this, I would just like to remind everyone that there's a survey sheet in the package. So if you can fill those up for us regarding the quality of the program and any suggestions that you have, please do so, and please give it back to our organizers on the table outside. So, questions, please.
Tôi có một câu hỏi là có một cái sự liên thông giữa cái rủi ro tín dụng và cái rủi ro hoạt động, mà tôi thấy ở Việt Nam của tôi thì thường là những cái rủi ro hoạt động dẫn đến rủi ro tín dụng. Ví dụ có một cái khoản vay với một cái tài sản thế chấp trị giá vào khoảng 50 triệu đô la, nhưng người ta cố tình đưa cái giá trị đó lên một khoảng 80 triệu đô, Và cái chuyện mà đưa lên 80 triệu đô là cái chuyện cố tình gian lận, cái đó nó thuộc vào cái rủi ro hoạt động, nhưng nó có thể dẫn đến là một khoản vay cao hơn nhiều so với cái khoản vay thực, và như vậy có thể dẫn đến là một rủi ro tín dụng sau này. Hoặc là ví dụ như một khoản vay mà những cái cá nhân trong cái phòng quản lý rủi ro không tán đồng, nhưng mà ông giám đốc cũng cứ quyết định cho vay, bởi vì cái doanh nghiệp đấy có thể là một cái doanh nghiệp của người thân quen của ông, hoặc là thậm chí là doanh nghiệp của cá nhân ông ta, nhưng mà nhờ một người khác đứng tên, và sau này thì là nó trở thành một rủi ro tín dụng. Bởi vậy cho nên khi mà tính cái rủi ro nào là rủi ro tín dụng, thì những thiệt hại nào thuộc về rủi ro tín dụng, và những thiệt hại nào thuộc về rủi ro hoạt động thì quả là rất là khó. Và vì vậy cho nên tôi cho rằng như là không biết ở các nước khác thế nào, nhưng mà chúng đánh giá rằng là cái rủi ro hoạt động của Việt Nam với những cái gian lận kiểu đấy thì có thể là rất lớn. Như tôi nói ban nay nên là có những người vay tới, một người mà vay tới cả nợ gốc lãi tới 125.000 tỷ, tức là khoảng 6 tỷ đô la. Thì các bạn biết là nó không chỉ là rủi ro hoạt động, không chỉ là rủi ro tín dụng đơn thuần, đấy là rủi ro hoạt động.
I think this is exactly the issue we were addressing with with the PhD work of that student I was mentioning. 62% of the portion of the losses could have been prevented.
Đây cũng chính là cái vấn đề mà tôi đã từng trả lời với một cái sinh viên làm cái tiến sĩ của tôi, và trong cái câu trả lời đó thì có nói rằng là 62% cái khoản tổn thất này đều có thể phòng ngừa được, kiểm soát được.
So, what are the 62% comprised of? Number one, as you mentioned, credit committee says no, CEO says yes. Okay, there is no good reason to say yes when the credit committee said no. So this is a corporate governance issue.
Và có rất nhiều cái yếu tố trong cái phần mà chúng ta có thể tránh được cái 62% cái tổn thất này. Cái ví dụ của anh nói rằng là cái nhân viên tín dụng nói rằng là cái khoản này rất là rủi ro, không nên cho vay, nhưng mà cái người lãnh đạo cao nhất của ngân hàng lại nói là có thể cho vay được. Thì đây là một cái vấn đề về rủi ro về mặt quản trị doanh nghiệp. Vì không có lý do gì mà khi cái nhân viên, cái chuyên viên về cái vấn đề tín dụng nói là không nên cho vay, và ông giám đốc lại nói là cứ cho vay.
Corporate governance, that means the CEO is not acting in the best interest of his organization, and there's nobody to stop him because he's the boss.
Và cái vấn đề ở đây là cái ông chủ vì cái mục tiêu nào đó đã đi ngược lại với lợi ích chung của cả doanh nghiệp, mà lại không có ai đứng ra, hoặc là không có ai đủ quyền lực để cản trở ông ta.
It can be on a lower level when people don't do their homework. They give credit without complete data sets. They haven't done a proper due diligence.
Điều này cũng có thể xảy ra tương tự với những cái trường hợp ở các cái cấp dưới, cấp thấp hơn, những người quyết định cho vay tài chính mà không qua những cái thông qua, hoặc là không lắng nghe những cái nhận xét của các cái bên phản biện về vấn đề rủi ro.
Or it can be on the level of collateral. People receive collateral, a counter value for the loan, and they do not check the quality or the ownership of that collateral. Do you actually own that collateral which you give us, or is it somebody else's?
Và cái phần cũng có phần nữa là cái rủi ro liên quan đến là chúng ta không kiểm soát được cái tài sản cầm cố để chúng ta vay. Thực ra là cái người vay đấy có phải là chủ sở hữu thực sự của cái tài sản cầm cố hay không, chúng ta không nắm rõ được, thì nó cũng rất khó để chúng ta.
Or you can have simple operational processes that cost money. You pay the loan before you receive the collateral. You pay the loan before you receive the counter value collateral. The collateral is meant as a security against the loan. So you want money, you give me your watch, okay, as a security. That's my collateral. If I give you the money before you give me the watch, I have a risk.
Okay. Nó cũng có ý của anh ấy nói là trong trường hợp mà khi người ta trả lại vốn vay thì khi mà ngân hàng mà chưa đưa lại cái tài sản cầm cố cho mình mà mình đã trả lại tiền thì đấy cũng là cái nguy cơ người ta bị mất cái tài sản cầm cố.
And of course, the last one, you can have credit fraud. People making you believe all the good things, though you give them the loan, but actually they've been lying to you all along.
Và cũng có một cái trường hợp khác là người ta làm giả hồ sơ giấy tờ để cho ngân hàng có những thông tin thuyết phục và cho chúng ta và cho họ vay.
That's why 62%, according to that PhD thesis, are operational root causes for credit defaults.
Và đó chính là những cái yếu tố chính mà phản ảnh được cái lý luận trong cái bài bảo vệ luận án tiến sĩ của cái sinh viên đó, nói rằng là 62% cái tổn thất có thể tránh được nếu như chúng ta hạn chế được những cái rủi ro về mặt hoạt động.
And I know I'm not very popular when I say this, but if you think about it, with these results, the regulators do not ask for enough capital for operational risk.
Tôi thì không chắc lắm là các anh chị có nên chấp nhận cái rủi ro đấy không, hay là đang làm như thế nào, nhưng mà trong cái phần chúng ta quan tâm là liên quan đến rủi ro hoạt động thì chúng ta không biết là các cái lãnh đạo cấp cao nhất của mình đã từng hỏi chúng ta các cái rủi ro trong hoạt động của mình là gì chưa.
Do we have more questions? Okay. Sweet mountain.
Yeah. For the first one, this is the how to identify the roles of risk control, control, and risk control. Câu hỏi thứ nhất của các anh chị đó là phân biệt vai trò của kiểm soát nội bộ và quản trị rủi ro hoạt động. Quản trị rủi ro.
Okay, internal control, as you have seen on those 4 stages. The first stage is the basic stage, is controlling what's happening in your business. So that's when internal control is active, making sure that things do not happen in the process.
Chúng ta thấy trong cái phần kiểm soát nội bộ của chúng ta thì có thấy có 4 điểm, và cái phần 4 điểm này là nhằm đảm bảo chúng ta biết được là chúng ta đang làm gì, và quá trình đấy là một quá trình chủ động.
So operational risk management comes at the second stage, where you bring in a structure in the way you manage your risks.
Và cái phần quản lý rủi ro hoạt động thì nó sẽ là cái bước thứ hai, là chúng ta nhận diện được những cái rủi ro trong cái hoạt động hàng ngày của chúng ta trong cái kiểm soát đấy, thì chúng ta nhận diện ra được rồi thì chúng ta có cái biện pháp để phòng ngừa. Như vậy là tôi căn cứ vào cái kiểm soát nội bộ thì chúng ta sẽ có được cái biện pháp để chúng ta quản lý và hạn chế các rủi ro. Câu hỏi tiếp theo đó là mỗi ngân hàng đều có KPI khác nhau. So is it true that every KPI would be different or differ from one bank to another?
Yes, basically yes. What I recommend, we have been doing some KRI benchmarking between banks. For instance, we help the Australian banking industries to benchmark their e-risk indicators, so their risks they have with e-banking.
Chúng ta về cơ bản thì các ngân hàng cái đặc thù kinh doanh khác nhau thì sẽ có những cái rủi ro khác nhau, cái KPI khác nhau. Tôi lấy ví dụ như là một cái ngân hàng kinh doanh đầu tư ở Úc thì cũng có làm những cái so sánh cái rủi ro của họ với các ngân hàng kinh doanh tín dụng trực tuyến hay là điện tử.
Of course, we recognize that every bank is different size, different volumes. So we find the best common denominator so that we can actually benchmark these data.
Và chúng ta thấy là các cái quy mô của các ngân hàng cũng có khác nhau. Tuy nhiên thì chúng ta cũng có thể tìm thấy những cái điểm chung mà chúng ta có thể dùng để so sánh.